It usually starts on an ordinary day. A phone rings, a car swerves, a doctor clears his throat, and in an instant, life changes. One moment, you're thinking about dinner plans. The next, your family is facing medical bills, mortgage payments, and years of lost income, all while trying to grieve and hold everything together. No one wants to imagine that scenario. Most of us assume we have more time. More time to get healthy, more time to build savings, more time to take care of all that paperwork. But the truth is, none of us are promised tomorrow. Scripture doesn't tell us to live in fear of the future. It tells us to prepare for it. Proverbs 27:12 says, "The prudent see danger and take refuge, but the simple keep going and suffer for it." Stewardship isn't just about growing wealth. It's about protecting what God has entrusted to us, our families, our income, and our future. That's what insurance really is. It's not morbid. It's not unspiritual. It's one of the most tangible ways to love your family, to ensure that if the unthinkable happens, they're protected, provided for, and positioned to continue building what you started. Because when that ordinary day comes, and for all of us, someday it will, the question won't be how much we made, but how well we prepared. Today, we're joined by our trusted friend and insurance expert, Kris Lehner, to talk about life, disability, and long-term care insurance, what they are, why they matter, and how they fit into a biblical view of stewardship. Welcome to Plan to Prosper, where we exist to honor God by equipping faithful servants to steward their finances wisely and build wealth that endures for generations. All right, Logan, we are back, and we have a very special guest with us today, our friend, Mr. Kris Lehner. Kris, welcome.
Well, thank you very much. I appreciate it.
We're very excited to have you. And Kris has been a longtime friend of the firm.
Yeah.
How long do you guys go back? It predates me.
Predates me.
Yeah?
It might be close. I shouldn't say this. It might be 20 years.
That's awesome.
Wow.
How did you first meet Doug?
I met Doug up back in the locker insurance. I was introduced to him by the guys up at Locker Insurance. And I think he was with one of his coworkers at the time, George. And we had a visit, I think for the sole purpose of just meeting, getting to know one another. And I've always felt with Doug that there was a kinship. We were a little simpatico.
Yeah.
So I always enjoyed his company.
Good. And the rest is history.
Yeah.
So for our listeners who don't know you, just tell us a little bit about yourself, your background in insurance, and even some personal stuff too.
Well, give me a for example.
How long have you been with your firm? And what do you do there?
Well, I'm a principal, meaning I'm one of the owners of our agency, which is called Drake Lehner Morgan, LLC. I think that entity has been in existence legally since 2003, but we have been working together probably since the mid-'90s. So we've been doing it a bit.
Where were you before you formed
the
firm?
All three of us started at a career agency, which is how most folks on my side of the world started back in the 90s and before, where you would actually go work for a manufacturer, meaning an insurance company that manufactured insurance, and you would exclusively represent their particular life and disability products.
Did you go to college expecting to end up in insurance?
I don't think anyone does. I am almost certain no one does that. I ended up in it because for college, my undergraduate was in history, so that's about as far from insurance as one can get. But I ended up there primarily because I wanted to be self-employed, and the barrier to self-employment entrance was lower there, meaning all the upfront costs you needed and everything else. So I viewed it as a path to self-employment. And there was probably a personality match, to be honest, in the end. And our business is pretty wide and broad, so I could gravitate to things that interested me more than other aspects of the insurance business.
I did not know you were a history major.
Yeah.
And that makes a lot more sense now, because a couple months ago we were talking on the phone, and you often ask me, what books are you reading right now? And you asked me that question, and I said I was reading a biography on Stonewall Jackson.
Oh, yeah.
And then you proceeded to tell me all the things that I didn't even know yet, and I was the one reading the biography at the time. So that makes a lot more sense.
Who wrote that one?
That was Gwyn.
Okay, I don't know that one.
Okay. Yeah, it's called the. I can't remember what it's called.
He's a very interesting cat.
Rebel Yell is what it's called.
Yeah.
Yeah. But yeah,
Southern Presbyterian.
that's right. R.L. Dabney was his pastor.
Yeah.
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 Very cool.
What about family?
I'm married to Brenda Jo. We've been married since 1991, December of 1991. We have 2 kids who we're both very proud of. Gina is our oldest, and Kris is our youngest. They're adults, young adults. Gina's up close to New York, and Kris is in South Jersey.
Do they have any kids?
No.
No. Okay.
Kris, same spelling?
Same spelling, yeah. Yep.
Yeah. So we read this in the cold opening, Proverbs 27:12. The prudent see danger and take refuge, but the simple keep going and suffer for it. And
How'd you come up with that verse? Who came up with that verse?
I did. I put it in the.
Did you know it? I didn't know this. It's the same verse, basically, as Proverbs 22:3.
No.
It's like almost word for word. It was just interesting to me. It like repeats itself.
You have that a lot in Proverbs. You
Really?
have that a lot in the Psalms.
Okay.
Yeah. There's one psalm that's like almost verbatim repeated in like First Chronicles because David was reciting it. But
Yeah.
yeah, it's pretty cool.
Yeah.
So the idea there is you see a potential problem on the horizon and a prudent person does something about it. Whereas a simple-minded person sees it and just keeps going. And I think insurance is a pretty good example of how to see a potential problem in the future and do something about it.
I agree with that.
Yeah. So today we want to talk about, because you primarily deal with life, disability, and long-term care.
Yes, primarily. Yep.
Any one of those 3 you deal with the most on a day-to-day basis?
You know, it probably leans in the direction of life insurance, but that would also depend on the season.
Yeah.
And by season, I mean, we don't always control what work comes to us.
Yeah.
So there are seasons where it's just lots and lots of disability or lots and lots of long-term care or lots and lots of life insurance. So the life insurance that we end up working on will either be directly to an individual or to a business or to a trust.
Okay.
Do you find more insurance like at the beginning? Is it sometimes like a New Year's resolution? Do you find more in the beginning of the year as like I needed to?
Not really.
Okay.
Although what I have noticed, and I don't know if this is answering your question, in terms of quarters, if you took the year into quarters, starting from like January 15th to like the first week of summer, it's like you're on the back of a roller coaster and you're hanging on for your life. And then the fourth quarter is the same way.
Okay.
And then it seems to me in July and August, it's like stalls. It's like the seas are just...
Everybody's on the beach.
Yeah, I think so. It's where you catch your breath, or at least I try to.
That makes sense. So you have been, to explain our relationship a little bit more, for our firm, we don't sell any insurance products. We don't earn commissions on insurance products. We're fee-only advisors. But we believe that this is an important part of your financial plan. And in fact, we have this resource that we put together, and we did a whole episode on it called The Path to Prosper. And the idea is, it's kind of like if you think about Dave Ramsey's baby steps or any other one of those types of things where it's just, here's what you can do to get your financial life in order. One of the things when we were putting that together that I don't like about the Dave Ramsey baby steps is that there's nothing at all about protection or anything about insurance, which I felt was an important thing to address. So we actually put it as step 2. We asked these questions. Number 1 was, are you giving? If the answer is no, maybe consider start giving. Yeah. If the answer is yes, then you can move on to step 2. And step 2 is, do you have loved ones and people that depend on you and your income? If the answer is yes, you need to look into some sort of life and potentially disability insurance as well. And there's, a lot of, more nuance to the conversation of, well, how much, what kind, and all that stuff. But we put a high priority on it in that resource because it's pretty important to make sure that, and it's a simple enough thing to implement. It's not like, even saving an emergency fund, which could take years of disciplined saving, you can get a life insurance policy within a few weeks by just starting the process. So we think it's something that's an important thing to tackle. But so we put that right at step 2 is let's take care of that. If you have loved ones depending on your income, let's make sure that they're protected in the event of the worst case scenario.
It's the defense before you start the offense, right?
Right. Yeah, because there's this period of time between building wealth and being essentially self-insured by the time you get to retirement age or whatever, where for a lot of people, while they're in the midst of their careers, their portfolio is not big enough to sustain their family if something were to happen to them. So handling that well before any disaster comes is our conviction. But we refer people to Kris because he does really good work. We'll get them the policy that's right for them, and we're not. There's no like incentivization for us other than we know that you do really good work for them. And so,
thank you. That's very kind of you.
That's a little bit about our relationship with Kris. But yeah, so we want to tackle those three main things: life, disability, and long-term care today.
Okay.
Because there's so many different kinds, and we can start with life insurance. Can you just give a brief, like, what are the different types of, people probably are familiar with whole life insurance if they've heard of that, or term life insurance, but there's even more beyond that. What are some of the different types of life insurance that somebody could get, why they might want one over the other?
I thought about that a little bit even yesterday. They have a lot of different names, but I'm thinking back to doing our studies at the American College, and when they would go through what different insurances exist, you'd have the life insurance, you'd have the term insurance, and you'd have some form of permanent insurance. And believe it or not, what I remember from the textbook that it described term insurance is when the need is temporary. So temporary could be when the kids are little, or as long as I have this mortgage, or as long as I'm in this business partnership, or I just bought a commercial building and I need to make sure that I've got enough to make sure, and on. So meaning there's a very definite time period during which I need it, after which I won't need it. So that is term insurance. Generally speaking, what a person pays will be level over a particular period of time, 10, 20, 15, 30 years. So that's term insurance. Mm-hmm. Permanent insurance is exactly what it implies. For whatever reason, the person that has it believes that this need exists as long as I'm alive. So if I pass away when I'm 35 or 105, I need there to be a death benefit for whatever particular reason. Mm-hmm. You start to see that in really when folks are focusing on certain estate objectives, wanting to get money to the next generation, wanting to equalize when I'm giving to kids. I may have a special needs child that needs to be taken care of when I leave, because even in my old age, I'm taking care of this child. Mm-hmm. So that would be permanent insurance. Permanent insurance could have many qualities to it. Yeah. A lot of which, for lack of a better way of saying it, is bandied about in the financial press in a way that I think is unflattering, number one, to the industry, but number two, to the consumer. It's just too confusing. It seems that it always wants to pitch using this as the new investment over and against death benefit protection. I have a tendency to think about it in terms of how long I need the death benefit protection to go, mm-hmm. meaning for short or forever.
Yeah. Okay.
That businesses will use the various types for different reasons to back up certain benefit programs that they have. So it's not uncommon for a business to use some form of permanent insurance to backstop a non-qualified plan or split dollar program or something like that. But that's not what a normal, like one of the three of us, like Johnny Lunchbucket, would be using that for.
Yeah. How is that different from whole life?
Well, that could be a form of whole life.
Oh, okay.
So what you just said, whole life, and then the other phrases names that we'll hear, universal life, variable universal life, they are all just certain forms of permanent insurance.
Got it.
So meaning they can go all the way to the end.
Okay.
Some may have more cash value or equity in the policy than others. Some may be built to do that, but they're just different forms of permanent insurance.
When somebody comes to you wanting life insurance, do they typically know what they want? Like, I want this universal variable life policy. I want a term life policy. Or do you guide them with questions along the way and to try to figure that out for them?
A combination.
Yeah.
Some folks are going to have a very definite opinion. I want X, which is fine. Fortunately, we have not had that many death claims in our career, fortunately. But the ones that have happened were impactful. So, like, I feel as a practitioner, my primary care is to make sure they have what they need, or is what they can at least get close to what they need. I could care less which it is, but generally, I like to get to know the folks that we're dealing with, get a sense of their financial picture to see what fits into that picture. If you're dealing with someone with little kids and people are starting their careers, I most of the time it's let's just get as much term insurance as you can afford to backstop the family while we're doing that.
Yeah. And that makes sense. That's typically, in the majority of the clients that we deal with when we are doing new financial plans for a young family, that's almost always what we're recommending from an affordability perspective, and also just this is really the gap that you really need to cover.
And if you're chasing kids around, right, and you got multiple kids, you have limited bandwidth to be making long, thought-out decisions on everything. Sometimes you just need to go, boom, slap a Band-Aid on it, and let's get on to the next thing.
Yeah.
Do you have an opinion on, say, it's a young family with little kids, but husband and wife in 5 years want to buy a property in Hawaii? Do you have an opinion on whether or not they should get enough insurance that if husband or wife dies in 2 years, opposite spouse can still buy that property in 5 years?
I would say it's up to them.
Okay.
They drive that.
Yeah.
And it's up to them, A, and then B, can they get underwritten for the amount that they need, which is generally driven by income and health.
Okay. Makes sense.
Do you have we've talked about how much life insurance do you need? And we've shared 10 times your salary kind of a thing. Do you have other things to consider when, obviously you just mentioned get as much as you can afford.
Yeah.
Are there other things that you help guide people through to help them think through how much might I need? I don't even really know where to start on this.
Well, you guys use e-money, right?
Yeah.
So I mean, I know how it works. I have it, so I know what you're using. So that's why I have it. I use an Excel or I use my 12C, and I would just calculate. I would just want to know, tell me about your debts, tell me your income. What is it you want to have happen if one of you dies before we'd like everybody to? And we're just calculating backwards, saying, okay, here would be the net present value of that number. And then, is that affordable? It almost always comes between 10 and 20 times a person's income. Almost every time you do, whether I do it in an Excel spreadsheet and I factor in college and mortgages and cars, if I do it on my calculator, it almost always ends up between 10 and 20 times a person's income. Unless they have zero debt, they have, next to no expenses.
Yeah.
But that's not most people that are on the beginning side of starting life out.
Yeah.
Did that fully answer your question?
It did. Yeah.
Okay.
Yeah, because I think it obviously everybody's different, and just saying 10 times your income that's not going to work for everybody. But I think it's a good starting place to at least think about if you have no idea how much you might need.
Here would be the one modifier to that, and what always concerns me in us helping folks is I don't necessarily want to put burdens on people's thinking. So what I mean by that is, if we're saying 10 to 20 is great and that would be just, perfect, but the family you're working with can't afford that, they're better off doing 5 times rather than doing nothing.
Yeah.
Or spending money that they should be spending on something else on this and making things really tight and uncomfortable.
Yeah.
I do think that makes sense. You and I, within the last couple of years, we're working with somebody that I know who, when I ran the first e-money plan, I think it was like 50 times his income.
Yeah.
And we settled on somewhere between 10 and 15.
Yeah.
So yeah, it seemed to make sense for them. And sometimes those e-money projections can just show ridiculous amounts needed.
Well, the other thing is it's interest rate driven, or at least my perception of the way when I run it, meaning if I make a particular assumption about what asset growth is going to look like, that's going to lock in a figure. Let's just say it's $2 million. If I adjust that by 50 or 100 basis points up or down, you got a totally different number. Mm-hmm.
Yeah.
And we don't know necessarily what that's going to do into the future. So this is part art and part science.
Right.
The other thing is your e-money, let's just use that person as an example. They might say, okay, this person needs $10 million of death benefit for whatever reason. That person has a picture in their head that a lot of coverage is $1 million, which does not correspond to your e-money calculation.
Mm-hmm. Right.
So that factors into it. So sometimes that person needs 10, but they're getting 1 because they think it's a lot.
True. Yeah.
Right?
Yep.
I think you see that a lot. Actually, I think you see that a lot in your demographic because I welcome your opinion on this. In terms of our national wealth, I feel like the generations grew up in different environments. Like I'm ahead of you, but I never would have expected people my kids' age to be making the kind of money they are. Mm. You know what I mean? So you'll see people in my generation going, oh, $1 million, that's a lot of insurance. You'll see that next generation going, could that do it? Is like $1 million going to get that done?
Mm-hmm. True, yeah.
So you have like this total different picture of what's a lot.
Yeah. Yeah, I agree. I even think about like, I'm a big Survivor fan, watching Survivor, the show.
Yeah.
And I think it started in like 01 or 02. And
Wow.
it started where the reward was, for winning the show, was $1 million. And it's still, to this day, $1 million. And I just think, is $1 million, like, how big a deal is $1 million now?
That's right.
Versus back
yeah.
then.
Well, that's why I answered the quiz question at 500,000, just because of the generation that he was in.
Yeah, yep.
That's a good call.
Back in the 70s, that was probably a lot of money. That was a lot of money.
It is funny because we show that in our financial plans. We show the present value in addition to the actual value of of somebody's portfolio through the years. So each year you see both a portfolio number, but then also what's the present value of that? Because by the time we've got a 30-year-old that gets to age 75 or something, and he's got a $50 million portfolio, well, that's actually only worth, I forget what it would be, but let's just say it's worth like $10 million in today's dollars, something significantly less than that. So it's a helpful thing to keep in mind when you're thinking about the time horizons and the future value of dollars, that it's just inflation is a real thing that we have to take into account here.
That was one of the most helpful things I think I ever learned in terms of financial planning and insurance was just the time value of money. That concept alone, like I think if people get just that will be very helpful to them.
Yeah. Yeah.
What do you say to people, and this was me for a while, I have insurance now, and my opinion has changed, but what do you say to people who think, oh, I have to trust God to provide for me and my family. Why do I need to insure my life? If God wants me to die tomorrow, I'll die tomorrow, and he'll provide for my family.
I have heard that. Logan, I definitely don't view myself, and maybe this is wrong, but I don't view myself as someone's conscience, because there's space for people to hold that position. Right? I mean, you have the liberty to have that position. If my daughter were married to someone that held that position, I would ask them just to consider what happens if you can't go to work tomorrow and they're home with a child, if that's how it ends up being. It's a tough one, because I think there are some people that hold that view. The one other thing I hear along with that is they could live off the savings or whatever. And usually then my question would be, why are you going to work if you could live off the savings?
Yeah.
So I think that's a very tough question, and I think that's personality driven, and I'm not sure I've ever convinced someone off that. Mm-hmm. In fact, I'm sure I have not.
Yeah. When would you ever consider counseling? Obviously, it's against your interest, but are there situations where somebody just doesn't need to buy life insurance? It's a waste of money.
Well, actually, I think you would hear me say that.
Yeah.
I think there are times where you'll say to somebody, "You're fine." You don't, because sometimes, and we all know this. Sometimes certain personalities have a very high should level. Like, I should do this, and sometimes it's okay. Like, well, look, you've got X, you're okay. And sometimes they come to us because of that, right? They come to all of us because they want to know if they're okay. I'm simplifying it, but it's like going to a doctor and saying, is this a problem? No, you're okay.
Yeah. You and I were working with somebody else, I don't know, probably 6 months ago. And at one point you called me and said, I don't really know why this person thinks they need life insurance.
Oh, there you go.
Yeah. I mean, immediately, like a single person comes to mind that doesn't have a spouse or children. Maybe a policy that to cover funeral expenses or something like that. But
there would be one other reason for that, at least one other, and that is where you have family history. All the women in my family, all the men in my family had X, and I know someday I want to get married and have kids. Sometimes, if there's a rocky medical history, when you're healthy and you can get it, sometimes it makes sense just to get it while you can.
Got it.
Because we spent a lot of time with folks whose health changed and things got difficult, and now they're either paying more or they can't get it.
Does rocky medical history make it harder?
Oh my gosh, yes.
So
Yes.
disclosing that family history even while you're
Oh,
healthy.
I'm sorry. Did you mean
I mean family history, not personal
family
history.
history is a factor, but it's not the way I understood your question the first time.
Okay.
So if all the men in your family died at 68, that definitely puts you in a different risk profile.
To get it to 69 or whatever?
Yeah.
Okay.
Yeah. So that would definitely put you from an underwriting perspective, they would consider that.
Okay.
Okay. That makes sense.
But it's easier if you're healthy at the time than
Yeah.
if you waited a day and were diagnosed with something.
Yes, that's always a thing. And again, we live in an imperfect world. It's definitely imperfect, and people are not running around thinking, what am I going to do about life insurance? Mm-hmm. In fact, most young married people don't even know that you probably want to start thinking about this.
Yeah.
As a relatively young person, I still feel like I'm invincible.
That's good.
You sort of are.
Yeah. You're the president.
Yeah, you're the El Presidente.
Yeah.
Yeah, but I'm going to leave here and get behind the wheel of a car, and who knows?
In the monsoon out there, too.
Dude.
Yeah.
In this traffic.
Yeah. In this economy. Do clients typically overestimate or underestimate their life insurance needs when they come to you, would you say?
I don't know. I think it's straight down the middle. I don't know that they're. I think it's very rare where you have someone making $150,000 a year says I need $200,000. You're just not gonna. You know what I mean?
Yeah.
They kind of know it needs to be higher.
Okay. One other question, unless you have any others on life insurance. There is another thing that exists in the life insurance realm that we have been dealing with a little bit more increasingly, and that is the idea of using a whole life policy as your own personal bank, so to speak.
Yeah.
Can you speak to that just briefly? We could probably do a whole episode on that, but I would like.
I don't know that I could, to be honest with you. I
Really?
actually probably could not, but go on. Sorry, keep
No,
going.
I'm curious to hear your thoughts on this concept. You're familiar with it to an extent.
I'm familiar to an extent.
Yeah.
Every time I see what they give me, I'm shaking my head. I'm like, I must be missing something. Mm-hmm. Is that how you feel when you look at it?
Yeah. I think when we've broken it down to it's been a little while, but what kind of our impression of it is that it's an extremely expensive thing to do. It requires a lot of upfront capital, and it takes years, 10 plus years, before you start to see a real benefit that is actually valuable to you. And so if you have the capital and the time horizon, I think it's doable, but I think a lot of people think of it where they're not ready for that. And they hear infinite banking or whatever, private banking, and they think, wow, that sounds really cool. But without eyes wide open as to what is required of them and
when you see that,
how long it takes.
What's the family income range that you see this in?
Probably less than 100,000.
Is that about
or
consistent?
around there?
Probably around there, yeah.
So if you're just forget that the fact that you're talking about the infinite banking and your own personal bank for a second. On a family making 100,000 doesn't have a lot left over in the Northeast, right?
Right.
As a percentage of income, what is good to set aside for any category outside of food and clothing and shelter? Like if you take when those things come across my desk, you just said they're capital heavy, right? You have generally an enormous amount of money that's going into it. And the reason I ask the income is because I almost always see this in the middle, moderate, or lower income side of folks is where I see these things coming through. And when you do the calculation, you go, what's the percentage of your annual income that you're going to be putting into this? Have you funded a qualified plan? I think the folks that present these plans would say, no, don't put money in a qualified plan. Put it into this. It's better.
Yeah.
That wouldn't be my opinion, but I would rely on your thoughts on that. I mean, I'd fund the qualified plan before I did that.
Yeah.
And when we're building a portfolio, a financial house, if you will, right? Don't I want to have my 6 months savings first?
Right.
Don't I want to have my midterm, my mid category of saving and investments, and then my long term?
Yep.
To me, that would be okay. I guess you could do that. The one thing that I see, you use the phrase family bank, and that is how I've heard it presented. What I've seen the back end of is when you take money out of a permanent insurance contract in the form of a loan, you permanently change how that policy performs. And very rarely does it look the way it's illustrated. So where I've seen these things come across my desk is after 20 years, someone will say, I didn't pay anymore and I've been taking X out of it. You're like, okay, well, that's good, I guess. But there's not enough cash in it to keep it going and it's going to lapse. So everything that you took out over the last 5 years, the gain is going to be taxable as ordinary income in the year that the policy lapses. I would say that is common.
Okay.
So that would be, if I issued a caution on it, I would caution that.
Yeah.
I think I've seen it marketed in certain cultural communities as this group can do this, but no one ever told you about it.
Yeah. Yeah.
And I think that's insidious because I think you're pulling somebody into something that might not be it. When you talk to people about financial planning, you don't say this mutual fund, this money manager. You say we're doing a plan.
Yeah.
What are your goals?
Yeah.
What are we working with and how do we get you there?
Yep.
Right.
That whole family bank thing, it doesn't do that. It's look at the family bank, look at the family bank, look at the family bank. Well, how does that meet my goals? How does that helping me in the context of my overall financial planning? That's where it rubs me.
Yeah. Yeah, this is the secret of the wealthy. This is what they do, so you should do it too.
Well, I think that's insidious. I think you're really taking advantage of people when you do that.
Yeah.
Everybody has unique circumstances, so what I'm about to say isn't advice, but I have yet to run a plan where that type of policy is what is in somebody's best interest.
Yeah, Okay, theoretically, right? I capped out all my qualified plan options. So did my spouse. I funded up the 529s for the kids. I've got 6 months income in the bank. I've got some good midterm savings in case, whatever. And I've got an extra X. Okay. There you might say, okay, fine, but that's not how you see it. That's not how it comes through, right?
Right.
Right. And in that case, typically, the projections that we run will show that it's better to just invest.
Yeah, put it in the taxable account.
Yeah.
It is interesting thinking about, I'd never thought about how much you should allocate towards insurance, but if you're treating it in some ways like a savings account where you're trying to build this cash value. We did an episode, I think it was 2 episodes ago or maybe 3, about Joseph.
Mm-hmm. I saw it.
Okay, so famously, he saved 20% of during the years of abundance to prepare for the famine.
Yeah.
And we were talking about savings rates, and that 20%, I was like, that seems like a pretty good savings rate. I've never thought about how, like, if to your question earlier, how much of is your premium on that policy in relation to your income, if it's 20% or more. Well, we think that's a really healthy savings rate, but to be putting all of that into that one thing we would see that as an unwise use of that, what should be a really healthy savings rate.
I guess the back on that, just so that I want to, in full transparency, I own a decent amount of permanent insurance, but I'm not using it as a savings tool.
Yeah.
I'm using it to get money to either my wife or kids whenever I check out. Mm-hmm. And whether I'm 90.
Tax efficient way.
Well, it is tax efficient, meaning I understand the internal rates of return on death benefit insurance. And rather than me saving this particular block of money to give to them on a tax-free basis, I can pay an insurance premium over a period of time. But that's different. That meaning I got them through college already.
Yeah.
I should say Brenda and I got them through college already. And so those big things are done. Now it's just we love them and we want to give them something. Mm-hmm. And we're not Rockefellers, so life insurance is kind of a cool way to do it.
Yeah.
So when, the final thing happens, they're going to get a check. They're going to know that, mom and dad love them.
Mm. That's great. And that makes all the sense in the world. And I think we do legacy planning to an extent with clients. That's an important subject of conversation. When we're working with younger clients, we're often focused more on the wealth accumulation. But when we talk about what legacy building, that's a part of the conversation for sure, is what do you want to leave to your kids? And we want to try to help them build that wealth.
Yep.
But that is certainly a part of the equation too.
It creates good leverage, and the internal rates of return are decent.
Yeah.
The risk-free internal rate of return on death benefit is pretty decent.
Yeah.
I have 2 questions. We have more insurance to go over, though, so we can keep these relatively brief. In the age of DIY, I feel like millennials are very DIY.
Yeah.
Do you have any advice for people who try to DIY it with insurance?
How can you be more? I might not.
Instead of coming to you, I'm just going to get online and search for the cheapest way to get myself $500,000 or whatever in life insurance.
You can do that. What you're going to not get in there is someone who's done anything for any length of time that knows what's going on, who can guide a person. So where I see people getting snagged on that is because if I don't do insurance for a living, then I might not know that the new version of Copenhagen is those Zin packs.
Yeah.
I might not know that with this carrier, they don't treat me as a tobacco user, but this carrier does. So those are the types of things that you see coming back when people do that. And when people are doing that online, they're going to someone like me who decided not to do it face-to-face, but to do it through a website. You're getting the same insurance carriers, the same pricing. You're not getting a discount as a result of it. You're just not getting advice.
Okay. It's good to know. Second question, what are your thoughts about people that want to get some level of life insurance for like their 5-year-old?
And why would they do that?
A lot of times they don't know. It's just advice that they've been given.
We grew up in an era, you guys probably didn't, where everyone got the Gerber insurance for their kids. And I mentioned that when we started at working for I call it the manufacturer. When we started working directly for the carrier, that was a standard thing. Like, make sure that mom and dad and all the kids have it. And the reason that they would say that you want to do this is so that the kids, if their health changes, they can continue to buy insurance because there's a provision you can put in there so that they can, over the course of their life, continue to buy insurance. I don't want to bore you or the listeners with some of the shortfalls of that, but to say if the child needs insurance, then you would do that. No one wants to talk about what would happen if a kid passes away, right?
Right.
So if you want to protect their insurability, is the industry catchphrase, you could do it, but the death benefits are so small that when they reach the age of majority or adulthood, those death benefits are not really going to be that significant. And I mean, it's okay, it's not bad. And I'm saying this on the heels of being to 2 funerals of young adults, you know, who died just out of their teens this year. And I don't know if mom and dad did that. Like, I think in the end that might have helped things a little bit, but I don't think I really helped you with that answer.
No, that's just good to talk through.
It's not a should. It's not the great thing people are overlooking.
Mm-hmm. Okay. No, that's good.
Any other thoughts on life insurance?
I think I'm good.
I think we covered the bases pretty well there.
I think we put about everyone to sleep at this point.
I don't think so. The next category, Mike.
Kris, your beautiful face is keeping everybody awake.
God
Agreed.
help us all.
So we won't spend as much time on these next two, but disability and long-term care. Let's talk about disability a little bit. I think people don't always think about this one. Life insurance makes sense, why you might want to consider that. Disability, maybe not as much. It is often provided by your employer, but not always. And so we run disability analysis for people just to, hey, if you got hit by a truck tomorrow and you're paralyzed and you can't go to work, what would you do? How does your financial plan look? So you talk a little bit about how you counsel people through this particular question.
I actually think this is the gap in most people's financial plan. I think most people have an exposure that they may not necessarily have considered. Mm-hmm. So if you just go to what you said for you work for someone and they have it, the thing that people forget is the benefits taxed. So could we do like an example? Mm-hmm. So can you give me somebody's income? Just pick an income.
$100,000.
So that's $8,000 a month, right?
For what?
If someone makes right, they make that's $8,000 a month. So what do you normally see as a benefit for the group employer plans?
60%.
Up to
what?
On
$100,000, it's usually not maxed. 60% up to 300, like no more than 60% of like 300.
Usually the employer plan is going to say, we're going to pay you 60% for disability, 60% up to $5,000, $6,000, $7,000.
Oh, right.
It's probably going to be $5,000 or $6,000.
Okay.
What one do you want me to use?
6.
All right. So we're going to say 60%, that's $4,800.
Okay.
The guy or woman making $8,000 is now going to be down at $4,800. Someone who's making $100,000, what's their tax bracket? I'm looking at Logan.
What's their tax bracket? Somebody making $100,000. Yeah. I don't know. What is that? 22?
Can we just use 20?
Sure.
Right. So that's 80% is what they're going to retain, right? So now we're down to $3,840 per month of income. That's what I think the exposure is for most people.
I think some people have the option to make it to pay the tax beforehand, right?
They can. So now we're back above. We're at $4,800.
Yeah.
Right. So that is where I think the biggest gap is for most people. I think it's largely overlooked. I got my life insurance, the employer's got the disability, and there, for the most part, most people get to the end without having to trigger that. But when there's a claim, they generally go 3 years at least.
Yeah, I have a stat here that says 1 in 4 Americans will experience a disability lasting 90 plus days before age 65.
Yep.
Which that stat is baffling to me.
It's
Do
baffling.
you see that?
I have not seen that. What I have seen is we've had fewer disability claims over 30 years than life claims. They were catastrophic. They were not. One was a little more. One of them did not fall in the catastrophic. It's difficult and it's a fight to get carriers to do what they're supposed to do. But the others, they were lights out catastrophic. And at least one of those individuals died as a result of that. Mm-hmm. So my point in that was there was no question. It was, the 90 days was done. Carriers were paying. And they definitely needed, and not all of them had what they should have had.
Yeah.
One of them did. So anyway, to answer your question on the disability coverage, I do think that's a financial planning gap, particularly for individuals who are living right at the budget level.
Yeah.
Right. If I'm making this and I'm spending this, which again, for families in that building phase, I think we just described most of them.
Yeah.
That's where the gap would be. Self-employed individuals are going to be particularly pressed because they can't do it as affordably as someone who already has 80% of it covered through work.
Right.
They're going to be a bit more challenged. They're going to have to pay a little more to get that done, but they can do it. Again, health underwriting for that is even going to be a bit more of a challenge. I'm not trying to discourage people, but it's not a layup. If you've got any existing injuries, the carrier's going to say, yeah, I'm covering everything, but I'm not covering that bum knee from when you were in high school playing football. Mm-hmm. And that doesn't make people feel good when they see that come back. But
yeah.
Does it matter for, say I had a bum knee,
Mm-hmm.
I'm in financial planning.
Yep.
Does that matter for me?
Not if you're, generally speaking, if you've gotten treatment, getting treatment, or you've had treatment, and someone wrote down somewhere in a record, this is bad, a carrier would most likely say, we're not covering Logan's left knee.
Yeah. That doesn't affect how I do my job.
Doesn't affect how you do your job. And if you fell down the stairs and, broke the leg or whatever, something bad happened, that's not what they're referring to. They would pay for that. They're just not going to pay for it if as a result of something that's already there and it happened.
Is there an amount that you would typically write? So if 60% let's say that's the standard that you might get from your employer, would you say you really need more than that?
Well, the carriers are going to limit what you can do. So I would go I'd go to the limit. If they let us do that, I would want to go to the limit. It would not be uncommon where you have people with reasonable to higher incomes to have the employer plan be the bottom, and then you layer in a second plan for people that fall in a particular income range so that they could supplement what they have.
But they can't get more than a certain amount.
That's correct.
In totality. They take the employer plan into consideration.
That's exactly correct.
What's that amount? Is it 90% of their income? Is it different?
They're going to, generally speaking, you actually, I think, might have written it down somewhere like 65 to 70%, 75%, depending on the combination of the plans and carriers. You could probably get to a 75% income replacement ratio.
Okay. What if somebody works multiple jobs and they have disability through one but not the others? And let's say they do a lot of side hustles or something to drive for Uber or Lyft or DoorDash, and they really rely upon that income, but they also have a steady job where they do have 60% covered.
It's possible.
Okay.
It's possible. The occupation classes that you just used are good and noble professions. They're hard to insure for disability.
Let's say it's not those where you're driving a car, but
they're working
from home.
Yeah, they will definitely let you do that. They are going to in the disability universe, we are put in classifications like everything else in life. by what we do. So, if you're an attorney or an engineer, you're in one of the better categories. Or if you're a C-suite executive, they're going to have a better occupation class than people like me, as an example. So if you have multiple, they're going to use the lowest of those occupation classes to insure you.
Gotcha.
Read that, higher cost per 100.
Yeah.
How do you advise on priorities? So say I'm 50, I want to retire at 60, so I have 10 years. My advisor says you need to save $5,000 a month to retire at 60, but you have a gap in disability. So actually, you're only going to be able to save $4,000 a month because you got to pay $1,000 a month or whatever the amount is to cover disability.
How do I handle that?
Just what are your thoughts there?
You might not like them. I would tell you how it works, and I would say you and your spouse talk it over and figure out where you'd want to allocate it. The other thing I might say to you is, because when you get to 50, it's going to be an issue what that stuff costs, right? And using your exact example, that would price could be an issue. I do help try to explain to them, okay, if we don't want to do the big bucket, you could at least do a smaller version of it. So you don't have to necessarily do the big bucket. So if we're competing with dollars that need to be saved, I would suggest they go back with their spouse and discuss how they want to allocate their funds. But if they wanted to cut back on the disability, how could we do it?
Yeah.
Makes sense.
Can you briefly describe the difference between own occupation and any occupation?
Own occupation, I'm going to tell you, everybody wants this who knows what it is. I'm going to tell you, come claim time, I've never known that it made a difference. Excuse me, I have to be careful how I say that. The claims that I've come across in my experience, there are certain medical professionals where I've known of cases, but I'm just saying the ones so I think people want it, they're willing to pay for it. If it's one of Logan's cases he just described where we're competing, like what do I do? I might knock it down. So own occupation is if I can't do the duties of my occupation.
You're a surgeon.
I'm a surgeon. I can't use my hands get cut off. But I can go do some other form of medicine, please forgive me, to the medical community because I don't know what that person could do. Maybe consult on surgery, but not use my hands. They're paying me regardless of my income. Mm-hmm. So I'm making $500,000 a year. My hands are useless now. I get the full disability policy, but I get another medical job making $500,000 and they'll still pay me. That's own occupation.
Okay.
That's not inexpensive. Any occupation is by reason of my training and education, if I could do something as a result of my disability, maybe I can't do surgery, but I could do what you described before is I could do Uber or whatever.
Yeah. Then
they would say you have to do that. However, say I was making $500,000 here, and now here I'm making $50,000. Almost all these policies have a partial disability clause. So since there's that gap, the contract would probably still pay me something to make that gap up.
Okay.
They probably say you got to work, Kris, but you can only make 50 now, not 500. So we're going to fill in that gap. At least
to get to like 60% of 500 or just?
They would do it generally. When I've seen it, they've done a percentage of income.
Okay.
So if my loss was greater than 20%, I think they start at paying 50% of the policy benefit.
Okay.
And then they work from there.
Interesting.
Yeah.
Okay.
Like I said, the bulk of the claims that I've seen were total.
Yeah.
And it was not a question. There's one I've seen in the last year that was more challenging given its nature, but the rest were pretty black and white.
Okay. We only have a couple minutes left.
Yep.
So let's just briefly touch on long-term care.
Okay.
So what is long-term care and why might somebody want it or need it?
Well, long-term care is coverage that people generally are going to want to have when they lose their ability to perform 2 activities of daily living or they have a severe cognitive impairment. So think Alzheimer's, dementia, something like that. And this is the phase of life that, frankly, none of us want to really think about. Mm-hmm. It's kind of depressing to think about, where I can't bathe myself. I can't move from this chair to that chair. That's what that insurance covers. And as we've seen families not live generationally with one another, right? Like,
Yeah.
I don't live with mom and dad. They don't live with me.
Yeah.
You know, some would say fortunately, some would say unfortunately. I mean, that used to be family members would do this for one another.
Right.
So now you've got people living these siloed lives. Who's going to do this for me?
Yeah.
So I think that's why people need it. From a financial planning perspective, I always view this as retirement planning, to be honest.
Mm-hmm.
Meaning, we know a long-term care event is going to cost generally between $200,000 and $500,000. And what always concerned me was, if I saved enough so the e-money retirement plan comes out okay for the family, but 10 years into the deal, I go down and now I'm drawing down at a rate greater than we had planned.
Sure.
Okay, well, I'm getting care. That's good. But the problem is I'm going to make what's ahead for my wife in retirement not great.
Right.
Financially. So the long-term care really just gets that bucket of money available, so we're not sucking down our retirement assets or other assets.
Yeah.
Some people can self-insure, and if they're comfortable with that, they can.
Mm-hmm.
My question on that always is, it's okay when you go to buy anything, no one likes to buy cars, but no one pays list price.
Mm-hmm.
So my question with the long-term care is, why would you pay dollar for dollar if you could pay 25 cents on the dollar?
Mm-hmm.
That's the kind of the benefit of the long-term care.
Okay.
I could pay for it up front and then let the insurance pay for it. I'm just doing it with discounted money.
Yeah.
But you're competing with money that needs to be going into retirement plans potentially.
Yeah, sure.
So it's a decision that families would want to make.
Is that something that they would do? You know, I'm in my mid-30s. Is that something for me to consider at all now? Or is that something that you mentioned retirement planning, something to think about more a little bit later?
As you're doing your retirement plan, as you're doing your financial plan, I mean, you're a good example because you've got 2 and 1 on the way, right?
Mm-hmm.
So you got stuff you're getting ready for.
Right.
I think doing long-term care right now would probably get in the way of you taking care of some other stuff you want to do. So that probably wants to wait. I think of necessity.
But is it cheaper?
Yes.
Now? You know?
Yeah.
Yeah.
Time, million, money.
Yeah. Right.
Chris laying down the spoiler alerts for all the listeners.
What do you mean?
Have we not announced that on the show before?
I don't know. I can't remember.
Yeah.
Should I not have said that? You can edit
can
it
say
out.
whatever you want.
Okay.
I thought everybody on planet Earth knew about it. So
Okay.
having another baby. That's good.
It is. Congratulations.
Thanks.
Little people.
Yes.
Real quick, I'd just love any thoughts on, and it doesn't even have to be from an insurance perspective, the fact that people are trying to live as long as they possibly can these days.
Oh, dude. It's
Biohacking and stuff.
Oh, you mean as related to insurance or just general?
Just in general.
The genetics play. All right, so all the doctors or the people that know this subject matter very well, I'm going to just say in advance, I don't know anything about medicine.
None of us do.
None of it. All right, so like, my instinct is that probably doesn't work. You know, like we live in this, and I'm a runner, okay? So, but we live in this fitness culture where that's like worshipped.
Mm-hmm.
Yeah.
And the simple fact is, we know from reading our Bibles that our days are numbered.
Yeah.
So whether I run 7 marathons, you know, in my life or none, I'm pretty sure that those days are numbered. I think some of the
Doesn't Genesis even say like God set the maximum age at like 120?
I actually.
Mm-hmm.
Oh, I don't know that I would. I don't know.
Maybe that's not literal. I don't know. Yeah, I don't know. But I think it says it.
Yeah, I don't know, man. I don't put any hope in that. Let's put it that way.
Yeah.
Sure.
I kind of figure like, generally, if you look at family history, that's a better determinant of our longevity. I think what I hear some of these biohack people talk about is the whole objective is to make the last 10 years as good as they can be.
That makes sense.
Yeah.
I don't know.
No?
I mean, if you could, that'd be great. I don't know. Certainly
It's going to
not.
be tough no matter what. But
Yeah, man,
I'm just, make it as good as possible.
the last 5 to 10 look like they're rough.
Yeah. Yeah. Well, we don't need to get into it, but it reminds me, we'll bring it back to Stonewall Jackson. He had this great quote where he said, somebody asked him, how can you stay so calm on the battlefield? And he said, I'm as comfortable on the battlefield as I am in my own bed. God has fixed my days on earth, and I know that whatever he's prepared for me is what I'm going to do. So it's pretty cool.
It is very cool.
Kris, thank you so much for joining us today.
Well, thanks for having me. You guys are great. I really appreciate it. Thank you.
We'll have to have you back on because we didn't really get to everything that we wanted to hit today. So
I really appreciate it.
We'll do it again.
Yeah, definitely.
Thanks for listening to Plan to Prosper. God bless.
God bless.
Investment advisory services offered through Stonecrop Wealth Advisors, LLC, a registered investment advisor with the U.S. Securities and Exchange Commission. This material is intended for informational purposes only.